where rich people waste millions. Welcome, high rollers, future titans, and anyone who believes that a fat bank account automatically translates to financial genius. If you've ever looked at the ultra-wealthy and thought, they must have it all figured out, prepare for a reality check. Because today, we're pulling back the velvet curtain on a surprising truth. Even the richest among us can make some truly spectacular financial blunders. We're talking about mistakes that don't just trim the hedges. They can fell entire financial forests. These aren't just minor missteps. They are often multi-million-dollar miscalculations. We'll explore how a lack of diversification, the irresistible allure of chasing trends, and the insidious grip of emotional investing can turn fortunes into cautionary tales. Get ready to learn from the very expensive mistakes of others, so you don't have to repeat them. Only just ensure to subscribe, like, and share this video to others, and smash the bell notification so you don't have to miss any update. Now, let's dive into the first, and perhaps most ironic, pitfall for the affluent: over-concentration. Mistake number 1, over-concentration. Imagine building an empire, brick by brick, with one specific type of brick. That's over-concentrations. It's the financial equivalent of putting all your golden eggs into a single, very fragile basket. For the wealthy, this often manifests as an overwhelming percentage of their net worth tied up in a single stock, a single real estate development, or even their own highly successful business. Consider the founder who built a multi-billion-dollar company. Their entire identity, their legacy, and their vast fortune are inextricably linked to that one enterprise. While admirable, it creates an enormous, often unseen, risk. If that company faces a downturn, a disruptive competitor, or a regulatory challenge, their entire financial universe can be shaken to its core. We've seen this play out countless times, from tech giants to retail empires. Similarly, some wealthy individuals become enamored with a specific real estate market or a single trophy property. They might pour tens or hundreds of millions into a luxury high-rise or a sprawling vineyard, convinced of its perpetual appreciation. But real estate markets, like all markets, are cyclical. A localized downturn, a shift in demographics, or even a change in tax laws can decimate that concentrated value. Their perceived safe haven becomes a significant liability. The solution to this seemingly obvious, yet frequently made, mistake is diversification. It's not just a buzzword, it's a fundamental principle of risk management. Diversification means spreading your investments across various asset classes: stocks, bonds, real estate, commodities, and even alternative investments. Within stocks, it means investing across different industries, geographies, and company sizes. It's about creating a portfolio that can weather different economic storms. When one sector struggles, another might thrive, cushioning the blow. It is about not being overly reliant on any single outcome. For the wealthy, this might mean selling a portion of their highly concentrated company stock, even if it feels like selling a piece of their soul, and reinvesting those proceeds into a broader, more resilient portfolio. It's about understanding that true wealth preservation comes from balance, not from singular bets, no matter how successful they once were. Mistake number 2, chasing trends. Next up, the siren song of the next big thing. This is where even the most seasoned investors can fall prey to the collective delusion of the crowd. Chasing trends means piling into the latest hot investment, often without sufficient research, usually at its peak, and almost always driven by the fear of missing out, or FOMO. Think back to the dot-com bubble of the late 90s. Everyone, from seasoned venture capitalists to your grandma's neighbor, was pouring money into anything with a .com suffix. Companies with no revenue, no clear business model, and certainly no profits were valued in the billions. The wealthy, not immune to herd mentality, often led the charge, convinced they had an inside track on the future. When the bubble burst, fortunes evaporated faster than a free champagne toast at a tech conference. More recently, we've seen similar patterns with certain segments of the cryptocurrency market or the NFT craze. While these technologies hold genuine promise, the speculative frenzy that drove prices to astronomical levels often had little to do with underlying value. High net worth individuals, perhaps feeling they needed to be at the cutting edge, jumped in with significant capital, only to watch their digital assets plummet. They bought into the narrative, not the fundamentals. The problem with chasing trends is that by the time something is widely recognized as hot, the smart money has often already made its move and is quietly exiting. You're not getting in on the ground floor. You're often buying from those who did. It's like arriving at a party just as everyone else is putting on their coats. The solution? Due diligence, patience, and a healthy dose of skepticism. Instead of asking, "What's everyone else buying?" ask, "What's the intrinsic value here?" Focus on understanding the underlying business, the technology, the market opportunity, and the competitive landscape. Invest in companies or assets that have strong fundamentals, a clear path to profitability, and a sustainable competitive advantage. Resist the urge to be part of the in crowd when it comes to investing. True wealth is built on sound principles, not fleeting fads. It's about identifying value before the masses do, not joining them in a speculative frenzy. Remember, if it sounds too good to be true, it probably is, especially when everyone is shouting about it from the rooftops. Mistake number 3, emotional investing. This mistake is perhaps the most insidious, because it preys on our very human nature. Emotional investing is when decisions are driven by fear or greed, rather than by logic, analysis, or a predefined strategy. And yes, even the most stoic billionaires are susceptible to these primal urges. Consider the fear factor. When markets experience a significant downturn, the news cycles become apocalyptic. Every headline screams about impending doom, recession, and financial ruin. Even individuals with vast sums of money, who theoretically should be able to weather any storm, can panic. They see their portfolio values shrinking, and the fear of losing even more becomes overwhelming. In a moment of irrational panic, they sell their holdings, often at the absolute bottom, locking in their losses. They abandon their long-term plan, convinced the world is ending, only to watch the market recover and soar without them. This is the classic buy high, sell low trap. On the flip side, there's greed. When markets are booming and everyone around you seems to be getting rich overnight, the desire for more and faster can become intoxicating. This leads to impulsive buying, often of overvalued assets, simply because they've been going up. Investors might take on excessive risk, leverage their positions, or abandon their diversification strategy to chase outsized returns. They become convinced that the good times will last forever, ignoring all warning signs. This is the buy high, buy higher trap, often followed by a painful crash. Emotional investing is also fueled by cognitive biases. There's anchoring bias, where we fixate on an initial price point. There's confirmation bias, where we only seek out information that supports our existing beliefs. These biases can lead to stubborn adherence to losing positions, or an overconfidence in winning ones, long past their rational expiry date. The solution to emotional investing is discipline and a well-defined, long-term investment plan. Before you invest a single dollar, articulate your financial goals, your risk tolerance, and your time horizon. Then, create a written investment policy statement. This document acts as your financial constitution, guiding your decisions through market volatility. When fear strikes, refer to your plan. When greed tempts you, refer to your plan. Automate your investments where possible, removing the emotional component from regular contributions. Rebalance your portfolio periodically, which forces you to sell some winners and buy some losers, counteracting the natural human tendency to do the opposite. Remember, the market is a transfer of wealth from the impatient to the patient. Control your emotions, and you control your financial destiny. Mistake number 4, lack of due diligence. Finally, we arrive at a mistake that often surprises people when it comes to the wealthy: a shocking lack of due diligence. You'd think, with all their resources, their teams of advisors, and their access to information, they'd be the most meticulous investors. Yet time and again, we see high net worth individuals pouring money into investments they fundamentally misunderstand, or worse, relying blindly on advisors whose interests are not truly aligned with their own. This often happens with complex, opaque alternative investments. Think private equity funds with convoluted fee structures, exotic hedge funds with black box strategies, or illiquid real estate syndications. The wealthy are often presented with these opportunities as exclusive, high-return ventures. Without truly digging into the underlying assets, the management team's track record, the fee structure, or the liquidity constraints, They sign on the dotted line. They might be swayed by a slick presentation, a prestigious name, or the promise of outsized returns that seem to defy gravity. Another common pitfall is relying on misaligned advisors. Not all financial advisors are created equals. Some operate on a commission basis, meaning they earn money by selling you specific products, regardless of whether those products are truly in your best interest. Others might be more interested in managing a large asset base to collect fees, rather than actively optimizing your portfolio for your specific goals. The wealthy, perhaps due to their busy schedules or a misplaced sense of trust, sometimes delegate too much authority without sufficient oversight. They assume their advisor is a fiduciary, always acting in their best interest, when that's not always the case. The solution is simple, yet often overlooked. Conduct your own thorough research. Even if you have a team of experts, you must understand the fundamentals of every investment you make. Ask probing questions. Demand transparency. If you can't explain how an investment makes money, or what its primary risks are, then you shouldn't be investing in it. Period. For alternative investments, demand detailed prospectuses, audited financials, and clear explanations of all fees and potential conflicts of interest. For advisors, seek out fee-only fiduciaries who are legally bound to act in your best interest. Understand their compensation structure. Ask for references, and most importantly, don't be afraid to challenge their recommendations. Your money is your responsibility, and no one will care about it as much as you do. A healthy dose of skepticism and a commitment to understanding what you own are your best defenses against financial missteps. So we've dissected the common blunders. Now let's pivot to the actionable strategies that can help you avoid these multi-million-dollar mistakes and build a truly resilient financial future. The path to sound investing, regardless of your net worth, boils down to a few core principles. First, embrace diversification as your financial superpower. Spread your investments across various asset classes, industries, and geographies. This isn't about maximizing returns in any single year. It's about optimizing risk-adjusted returns over the long term and protecting your capital from unforeseen shocks. Second, commit to thorough research and due diligence. Never invest in something you don't understand. If an opportunity seems too complex or too good to be true, it probably is. Ask questions, demand transparency, and verify information independently. Your financial future depends on your informed decisions, not on a slick sales pitch. Third, develop a robust, long-term investment strategy. This means defining your goals, your risk tolerance, and your time horizon before you invest. Write it down. This strategy will serve as your compass, guiding you through market volatility and preventing impulsive decisions. It's your personal financial constitution. Fourth, master your emotions. Fear and greed are powerful forces, but they are terrible investment advisors. Stick to your plan. Rebalance regularly. And remember that market downturns are often opportunities for patient investors, not reasons to panic. Discipline trumps emotion every single time. Finally, seek qualified professional advice, but do so wisely. Look for fee-only fiduciaries who are legally obligated to act in your best interest. Understand their compensation and their investment philosophy. Use them as a resource, a sounding board, and an accountability partner, but always remain the ultimate decision maker for your own money. Let's quickly recap the critical takeaways from today's deep dive into the financial follies of the wealthy. Avoid overconcentration. Don't put all your eggs in one basket, no matter how shiny that basket appears. Resist the urge to chase trends. By the time everyone's talking about it, it's usually too late. Control your emotions. Fear and greed are your portfolio's worst enemies. And always, always do your homework. Understand what you own and who you're trusting with your capital. The lessons learned from the financial missteps of the wealthy are invaluable. They serve as a powerful reminder that wealth itself does not confer immunity from poor judgment. True financial wisdom comes from discipline, knowledge, and a commitment to sound principles. If you're ready to build a solid investment strategy that avoids these common pitfalls, we've got resources designed just for you. Check the description below for links to our free guides and articles on portfolio diversification, risk management, and how to choose the right financial advisor. These tools are designed to empower you, whether you're just starting your investment journey or managing a substantial portfolio. Don't let the mistakes of others become your own. Take control of your financial future today. If you found this analysis insightful, hit that like button. Subscribe to our channel for more engaging, analytical, and yes, sometimes humorous, insights into the world of finance. And share this video with anyone who needs a dose of financial reality. Your comments and questions are always welcome, so let us know what you think. Until next time, invest wisely and stay financially savvy.